We're still finding attractive places to buy, but we are lightening up in some of our healthcare holdings and in technology, just because the stocks have appreciated so dramatically. I mean, it was just a few months ago that we were listening to people say that technology was never going to work again, and we went in and accumulated during that time, and we bought Broadcom, and we added to Apple and some of our other holdings in the semi space and in Cisco, and that was a good decision. But now we're overweighted in the group pretty significantly, and so we are trimming back. And then our healthcare stocks have become, some of them have become overvalued. Not all, obviously. It's been a tough time for healthcare in the first quarter, but we were trimming in the fourth quarter, and we trimmed at the beginning of this quarter.
Mike, the other sector that's done well today is the banks.
Yes.
Despite broadly yields being lower, but I guess are pretty cheap and finding a little bit of impetus.
Yields are contained. I would say, I do think that the Deutsche Bank, Commerzbank thing, for sentiment purposes, helps, right? You saw Citi, for example, be a leader to the upside along with Goldman Sachs, the kind of capital markets-oriented firms, global firms, that it just seems like fine if that's one fewer thing to worry about when it comes to the banks. But, the yields have been sticky at these levels, but, the yield curve has not gotten much flatter, and it doesn't seem as if the yields want to go much lower from here. And by the way, the 30-year yield stays around 3%, so it's not telling a scary story about the cycle coming to an end as much as it is, just globally suppressed yields with central banks where they are.
Which is a bullish factor.
It's a bullish factor, yes, unless they're responding to an emergency. That's right, yes.
Speaking of the Fed, former Minneapolis Fed President Narayana Kocherlakota appeared here on the show last hour, explained the logic behind his call for a Fed rate cut. Listen.
It's more, I think, a preemptive risk management kind of position. It's not that the data looks bad to me. I think my view on the data is very similar to the baseline outlook that's out there among many forecasters. It's more that monetary policy is really about risk management. And especially when you're as close to the zero around as you are, you want to take out that, I think, have that preemptive cut in order to keep the economy as healthy and as strong as you possibly can.
That soundbite certainly getting a lot of attention, Mike, because, he was on the Fed not too long ago, prominent economist. This isn't like some investor calling for the Fed to cut interest rates. Is there a case there?
I think well, look, we know where he's coming from. I think he kind of would prefer the Fed err on the side of stimulating, getting inflation higher, not sort of being complacent about that target. So I think it's understandable on that level. But I do wonder if the market as a whole would welcome the circumstances under which the Fed would go there. And my guess is no, not from these levels.
Your point being, Mike, because they're unlikely to do the preemptive cut that he's looking for.
That's right.
And therefore, a cut
they would be more responsive to a deterioration in the numbers, yes.
Nancy, on that note, is the Fed not the key macro issue anymore for markets, since we've already had the pivot and we're unlikely to get that preemptive cut?
Yeah, hey, Wilf, I think people, investors, are thinking that this issue is contained, and it's not the driver at the margin as it was in the fourth quarter. I think the Fed has it pretty right, and that we're more likely to see maybe one more hike than a cut this year. But largely, I think investors are still focused on China for lack of any other catalyst. We're about to enter earnings season in a few weeks, and that will change investors' attention. But at the moment, I'm not as concerned about the Fed, certainly, as I was in October. And I think I'm pretty representative of the crowd.